In this week's video, we'll review the possible implications of a stock rally that just failed at a bull-bear inflection point. Commentary that follows was recorded after the close on Friday, February 11th. On Friday, the United States said that Russia could invade Ukraine at any time. This topic has been on our radar for some time, and more importantly, it's been on the market's radar for some time. So all of the charts that we've covered in recent weeks and months have known that this was a possibility. That will be true as we walk forward as well. It will be baked into the charts and baked into the data. Is it a relevant topic? Absolutely, positively, yes. The main segment of this week's video was recorded on Thursday evening, February 10th. Thus, these charts might be a little bit helpful. On Friday, the VIX was up 17.52%. ARKK closed slightly below the 200-week moving average. New highs, new lows recently. They've come close to flipping back to positive, but they haven't gotten there yet. Definitely need to see some improvement on this front going forward. NYSE advanced decline line up here was down 5.18%. The S&P 500 is still, as of Friday's close, within that 4 to 15% range, but it did give up the 200-day moving average at the close and has somewhat of a shorter-term double top look here where price was rejected around 4,600. In terms of some items that will be covered in more detail later in the video, on this chart, shorter-term time frames, 30-minute, also closed below the 200-period moving average shown in red. We dropped out of this consolidation box here and moved back into the lower base. And when price moved into this lower base area here, momentum picked up. So if anything, in the short run, this is a negative rather than a positive. A lot of the things on the screen here are things that we would use to defer a little bit relative to the hard data to see what would happen. So for example, if we have a tame VIX, this looks better, breadth is better, the S&P closes above the 200-day moving average, we hold support in here, and or when we drop down we have a bullish divergence. It gets a little easier to take the approach that we'll see what happens in this area. We didn't have that on Friday, and thus it's important for us under our approach to remain aligned with the weight of the evidence, which is what we've been doing in recent weeks. And that's incredibly important because if we don't do that, we don't have anything to manage against. Pause your video player here. This is a tweet from Sentiment Trader. It talks about another year, calendar year 1994, where the Fed was hiking interest rates. Noteworthy that the intra-year drawdown was a little bit less than 10%, 8.94%, not that much different from calendar year 2004 that we've been covering, and not that much different relative to the drawdown that we have thus far. Our drawdown on a closing basis is still a little bit under 10%. It's important to keep that in mind because we've already experienced a somewhat significant drawdown. We're not starting from the peak anymore. Also not surprising, 1994 rates are a topic. Look how volatile it was from January 1st out to the end of the year. When the market had this sharp drop here, was it the end of the world from a longer-term perspective? Not in this case. The S&P 500 eventually righted itself, and from that low at point B into the spring of 2000, it gained an additional 248%. Another stat in the box here, very rare to see what's been happening lately, also ties us back to an interest rate related year of 1994. You can pause your video player here, but this type of meeting that the Fed has scheduled for next week is 100% normal. It's the way that they do business. You can see they scheduled a similar meeting in January of this year. This is something to keep in mind as we walk forward relative to valuations. It's extremely important under our approach to use the model effectively and to use the hard data effectively. I have to wake up every day with the attitude that says we're not rooting for any particular outcome in the markets. We're not rooting for bullish outcomes. We're not rooting for bearish outcomes. What we want to do is interpret the data properly. We don't want to fight the market when it's going up. We don't want to fight the market when it's going down. Something to keep in mind when we cover the charts in this segment of the video that was recorded on Thursday evening. It was recorded with the understanding that you would be reviewing it on Friday. So it's strategic in nature, allowing you to look back, in some cases, to these charts here to understand what happened during Friday's session. After this segment, we'll link back to Friday and finish with some bullet points from Friday evening. This chart of the S&P 500 after the close on Thursday, February 10th. This is an upward sloping 200-day moving average here. Even after a wild session, you can read this tweet here, the market still managed to close above that 200-day. However, you can see this is an important area here. We consolidated below the 200-day. Now we're consolidating above the 200-day. This speaks to a possible inflection point. You may be wondering, there's only been one other time where we're able to check the boxes here in this tweet. That was October 27th, 1997. Therefore, it might be helpful to ask and answer, what happened walking forward from October 27th, 1997? If we consider this to be point A, the market reversed, in that case, sharply the next day, and rallied into 1998, into the summer of 1998. The gain between point A and point B was 35.32%, simply helping us keep an open mind about better than expected outcomes over the next few days. Now, realistically, in the present day, the stock market's probably not going to calm down until interest rates calm down. Interest rates on February 10th broke above this level here that we've been watching for quite some time, and also closed above the 50% retracement level here for this A to B move. Like the present day stock market, the bond market too is near an inflection point possibly. If you weren't following along on February 10th, we had an above expectation or hot inflation report at 8:30 before the open. The market gapped down in this direction here and then rallied to almost break even during the trading session. And then James Bullard, one of the Fed governors, came out and said that he was open to a 50 basis point hike in interest rates. And from that point forward, the S&P marched forward from roughly break even to finish down 83 points for the session here. There's a change on this chart here telling us to pay closer attention. And the VIX, not surprisingly, also spiked up on February 10th. It was up roughly 20%, finished up 19.79. Not that earth-shattering yet. If we keep moving in this direction here, that would be concerning. So this is at least worth mentioning and watching. Diversified basket of bonds, AGGIEF, covered this chart many times over the past year. This is what increasing fear looks like. This is the COVID plunge in the S&P 500. It's very, very difficult to argue at the close of Thursday's session that this over here at this point looks like anything other than a sideways consolidation box. Very, very similar situation here. This is your increasing fear, lower high plunge look, high yield relative to intermediate term treasuries. Still fairly tame in the present day and holding the breakout above these levels here. The latest reading that we had as of Thursday evening on credit spreads, you can see credit spreads have not widened yet in a meaningful way. As we've mentioned all the time, spreads can widen rapidly, but we've been volatile now for quite some time. This volatility started back in November, and you can really say that this volatility started all the way back in February of last year in terms of somewhat of a topping process into this correction, or at this point, a drawdown. That's a lot of time for the credit markets to think about what's going on, and yet this is where credit spreads are here. This is where they were at the height of the COVID fear, and this is the financial crisis way up here. This is during the trading session on Thursday, February 10th, 2:35 p.m. Eastern Time. Very, very difficult to say the monthly chart in the month of February is alarming. Consumer staples, defensive staples, were still underperforming SPY by 0.8%. Contrast that with this increasing fear look here, where the S&P 500 peaks in October of 2007. Very, very similar situation here. This is your increasing fear look. The ratio is below a downward sloping 50-month. S&P peaks here. Now we're above an upward sloping 50-month moving average. Discretionary stocks relative to defensive staples. Last thing this ratio did was make a new all-time high. So this is software stocks. Remember when I said the peaking process really began in February of last year? This is where the market starts to look forward and think about the Fed raising interest rates. It's almost a year ago. This is a big drop in this software index here. It was point A down here in 2016. The software index made a stand at an upward sloping 200-week moving average. That coincided, for the most part, with a relatively major low in the S&P 500 in February of 2016. Similar situation here. Make a stand at an upward sloping 200-week moving average, and this low here pretty much coincides with the COVID low in the S&P 500 down here. So now we've retraced 50% of this A to B move here, trying to make a stand at the 50% retracement, and also trying to make a stand at that upward sloping 200-week moving average. This too has an inflection point look. Why? Well, this looks worse than this. This one looks the best. You hold right at the 200. This one you pierce it intra-week a little bit. This one you wobble even more, pierce it even further intra-week, and then for the most part close up here back by the 200-week. So we're wobbling in here, but we're also trying to make a stand near two important levels. So this is an inflection point. We'll learn something if it holds. We'll also learn something if price gets down into this area here. The longer it stays, the more relevant it would become from a bearish perspective in that case. Very, very similar situation here. ARC weekly near an upward sloping 200-week moving average. Markets again forward looking. It peaks in February of last year. The market's looking ahead to the interest rate hikes that haven't even started yet. Very similar to the other chart. We'll learn something based on what happens near this potential inflection point. Last week we closed below the moving average, the 200-week moving average. Intra-week and intra-day on February 10th we are above, but we're very, very close to it still. Another chart with a we better pay closer attention inflection point like look. NYSE advanced decline line, moving sideways for a long period of time. Here's a bearish breakdown, and thus far, what once acted as support may now act as resistance. Concerns would increase if we move down into this area here. The longer we stay there, the more concerning it would become. It looked like during Thursday's session intraday that this was going to be a failed breakout and we were going to move into this area here. We'll see how it plays out. Right now, this is concerning. During the session on February 10th, still above that upward sloping 10-month moving average. And keep in mind, it's a long way to the end of the month. At the end of the month, you'd prefer to close if you're a bull above 4470-ish, because this number too will change during the month potentially. Good to have reference points on multiple time frames because they can help you prepare. Relative to our time frame, are we really making decisions based on 30-minute charts? No, we're not, but they can help us make and prepare to make decisions on our time frame. So this is a look at the S&P 500 30-minute at 1:17 p.m. Eastern Time on February 10th. Hard to see maybe, but price is up here. And then if we fast forward to the close, we came down and tagged this upward sloping trend line. There's nothing magical about this trend line here. It's simply a reference point. This is the 200 period average for the 30-minute chart. It is also a reference point. There's certain things that we would like to see in here from a bullish and bearish perspective relative to possible support and relative to momentum in RSI. Just see how it plays out. Have we seen anything that's outside of the normal 4 to 15% correction window that we've been following for quite some time? The answer at this point is a definitive no. Right now, this is a 4% drawdown. This is 5. We're a little over 6. That would be the good news. The bad news is we're not out of the woods over here yet. This is still a battleground for the markets, and we'll see how it plays out. But right now, we've never closed at a 10% loss yet, so we're still in pullback territory, not correction territory. Some good, some bad here. 250-day moving average in silver thus far we've held. This somewhat upholds the 1996 analogy. This really isn't a good look here, though. Short term, this too is telling us to pay closer attention. Also tells us not to assume anything about what's going to happen relative to this battleground in here. This is the weekly chart after the big sell-off on Thursday, February 10th. The S&P was still up about 4 points for the week. So reference point down here with RSI. All things being equal, your tamer pullbacks tend to make a stand in terms of weekly RSI near these areas here shaded in green. We're still in that range now, but if we start to look more like this, or this, those are typically associated with further drawdowns in the stock market. So we'll see how we close right now. This really doesn't look that bad as of the close on Thursday, but there's a whole trading day left in this week. This tweet down here about what can we learn about the Fed's actions over the past year. It's the old don't get stuck on a story. The Fed seems to have been stuck on the story that inflation was transitory, and they've been sitting on their hands for a very, very long time. In fact, inflation has been a problem for quite some time. We're seeing readings that are near 40-year highs, and the Fed, in some respects, is still in full emergency mode. They have the federal funds rate at basically zero still. They haven't hiked rates yet. They've only talked about it. And they're still doing QE. It's possible that the market's going to like it when the Fed starts to raise rates. Why would that be? Because the market doesn't want inflation to get out of control either. That's not good for markets, and that's not good for the economy. There's another set of reference points during the session on Thursday. This is 2:38 p.m. when the S&P was down 61 points. So when you're here, I won't walk through all of these, but there's several reference points on this chart, including the 200-period moving average here. This is a TDST level here. If we look at a similar chart at the close, here now we're down 83 points, but we're still above that 200-period moving average. And during the session on Thursday, what we're looking at short term is we have a base up here on top of a base. So this is a base here. So best case scenario says that this base holds. And in the coming days, the S&P 500 holds at roughly this 200-period moving average, or holds above this level here where my cursor is. That's the easiest scenario from a bullish perspective. If we drop into this base here, then you're starting to look at things like market breadth, you're starting to look at what the VIX does, and you're starting to look at things like momentum. Do you have divergences, or is momentum picking back up? Based on the weight of the evidence in here, something else that was reinforced or that we learned again during Thursday's session. When the S&P is up here on this 30-minute chart near break even for the session, trend strength model is looking pretty good. And it's pretty easy to look at those numbers and say today is a do-nothing day. But then when you get down here to the close, the numbers look quite a bit different. And that's telling us we're near a very important point, a possible inflection point. And what does that mean? Inflection means wouldn't be shocking if the market rallied strongly in this area, or it wouldn't be shocking if it fell apart and moved strongly or rapidly in this direction again. And the concept of a tipping point, a bull-bear tipping point, applies to all time frames. So it doesn't just apply to this 30-minute time frame. We can take it out to the time frames that are meaningful for us, daily, weekly, monthly. We're at an important juncture here, and we'll just have to see how it plays out. You can pause your video player here. This is Sentiment Trader. Just keep in mind that fear near the recent low was extremely rare. Off the charts rare in some cases. And that's telling us that this low here, where fear was extremely rare and off the charts rare in some cases, is still a potentially important point. But we don't want to make the same mistake the Fed made. We don't want to get stuck on a story. So no assumptions about whether this range holds, no assumptions about what happens if we have a retest of this low. And all of that's nothing new. These bullet points from January 7th still apply. And these bullet points from the January 21st video are back in play. Back on January 21st, we said the data looked like an intermediate term tipping point. We're back to that level numerically again. Thus, we have to respect the unfavorable environment until it improves. The market has to prove it. Hasn't done it yet. And these are the bullet points to make sure we don't make the same mistake that the Fed made. It's important to reiterate what we talked about on the 21st. No assumptions about the severity, duration, or resolution relative to what's happening in the S&P 500 today. You have to stay aligned with the weight of the evidence. That's how we manage risk. If we drift too far, then that's when things get dicey. We also have to balance risk and reward, and we do that by taking it day by day. And from a contingency planning perspective, you can say, what happens if the market holds here? What happens if we get into this area here and certain things are happening? What happens if we get into this area here and other things are happening? And what happens if we break this level decisively down here? We want to be prepared tactically, strategically, and maybe most importantly, emotionally. Don't want to get caught off guard by any moves that we're not prepared for. These wild swings that we've seen in here and this type of action that we saw on Thursday, not particularly surprising. We've covered this bullet point in the past. Rate hike scenarios ripe for whipsaws and rotation. A lot of indecisiveness and confusion on this chart here in 2004 when the Fed hiked the federal funds rate 5 times. I'm going to let you pause your video player here. You can find the Twitter handle here. Market profile says we could be still in a high single-digit return profile for the market this year, the S&P 500. It's exactly what happened in 2004. The year ended high single digits, roughly 9%. And there was a ton of volatility from January 1st all the way out to December 31st. Here's the Twitter handle. Have to give the source here because we're using so much of this great information. The S&P 500's PE ratio is only 1 point higher than justified using a discounted cash flow model. That speaks to valuations that were extended relative to this model and now have come back closer to reality. Can also use some simple back-of-the-envelope calculations with PE multiples and earnings projections and say it's possible the S&P 500 would finish the year at 47.19. We closed Thursday at 45.05. That speaks to the risk and reward between now and year end. It doesn't mean we go from 45 to 47. This 47.19 number would be way out here. A lot of odd things can happen between this point A here and this end of year profile here. Difficult to say that this is a good look for stock market bulls. That would be the bad news. The good news would be there's a ton of support down here. Always good to know where support is or possible support is in case things continue to be volatile, especially to the downside. So close on Thursday. This chart actually got worse between 1:54 p.m. It lost a little bit into the close. Really not what you would expect. Hard to say this down here at the moment looks like this over here. Has taken some steps in the fear direction. Here's another chart that tells us to keep an open mind about the market trying to make a stand relatively soon. A to B move here, retail. Relative to defensive staples, you can see price has been jumping up and down, and here the ratio near that 50% retracement of this big move. Notice, too, that this decline here started way back in Q1 of last year. Markets are forward-looking mechanisms, also telling us it's possible at some point in this calendar year they will look past inflation and past Fed rate hikes. Here's high beta relative to low volatility during the COVID plunge. We're just consolidating up here and don't have a breakdown look. Very indecisive look. The ratio is sitting right on a flattish 200-day moving average. XLE Energy relative to tech. RSI up here. terms of the history of these two ETFs, never been this extended in one direction. That's not necessarily bearish in the short run, but it is relevant in the short run, especially since RSI is down around 63 right now. Price-wise, this is a nice looking breakout right now if it can hold for energy over tech. However, here's the breakout level here, so we're somewhat still duking it out over here. So this is energy relative to tech. Similar situation here, energy relative to the S&P 500. You can see it. See this overbought level, and you have to put overbought in quotes because overbought isn't necessarily bad. In fact, it's a sign of strength. But it can tell us that the market could be overdone in the short run. But in terms of price, this is a nice looking breakout for energy relative to the S&P. Part of the problem is, in terms of chasing it, see where the breakout occurs? After really the first of the year. So if you're going to take capital and move it to energy after this breakout, you're putting capital in harm's way while the S&P 500 is incredibly vulnerable. Having said that, this is still a relevant breakout, and it tells us that a lot of these charts that have been moving sideways, we have to be open to them breaking out in this direction as well. This S&P 500 divided by energy. This rally here from the low in 2011 to this point B blew right through the 50% retracement since the first of the year and the 200-day moving average. Now we've got the 61.8 and this gap here. That doesn't mean any of that's going to hold. This chart, unquestionably, until something changes, is favoring energy at this point. There's just some reference points here as well. And notice, we gave up the 50% retracement and this level here and this level here since the first of the year. I'd really like to see the stock market settle down before we would consider adding to energy positions. This says a lot about what we've been experiencing in recent years. So this is SPY relative to XLE. During the COVID plunge, we get the most lopsided RSI in the history of the two ETFs going back over 20 years. And now, recently, we have the most lopsided in the other direction move in RSI down here into quote-unquote oversold territory. What's the takeaway here? Don't assume anything in these markets. Anything can happen at any time. Maximum flexibility 100% of the time. Long-term trend in energy divided by the S&P 500 intraday on February 10th. This is XOP divided by SPY 3:20 p.m. This is a monthly chart, February 10th. This is a downward sloping 50-month moving average. Not making any predictions about what happens on any of these charts. They're just relevant in terms of making longer-term decisions. We're extended in a very rare manner here. What could that possibly mean? Well, we have an example here, extended in the other direction in a rare manner. And notice, there's a multiple-month counter-trend rally. But this momentum here is so strong that eventually you move back and make a lower low. So if that happened again, and we're not saying that's going to happen, the scenario would be you'd get a counter-trend move in this direction and then eventually make a much higher high up here. Not a prediction in any shape, form, or fashion. It just puts this into some type of context. A long-term chart of energy divided by tech. This is a downward sloping 200-week moving average here. XLF divided by SPY on the 10th. Regional banks divided by SPY on the 10th. These are monthly charts. Intraday on the 10th, semiconductors still beating the S&P 500, SMH divided by SPY. This is a multiple year period of consolidation in XLC relative to SPY, and this is not an encouraging look intra-month. Here are the top holdings in XLC: Facebook, Google, Netflix, Twitter. You also have old school, Verizon, AT&T, Comcast, Viacom, CBS. Here's the COVID plunge fear over here. Here's the present day during the session on February 10th. These are mutual funds. Didn't have closing prices on Thursday evening, but we still have this breakout here. This is the peak here way back in 1999. High beta relative to SPY. This is the COVID fear plunge over here. Here's the look during Friday's session. Inflection again right near that 200-day. Dividend stocks relative to the S&P 500, a much lower high in the ratio relative to this high, but also doing some good things as well. This is a higher low relative to this low, and right now you're above the 200-day moving average. So nothing definitive here either yet. The long-term trend here at the moment is still pretty clear. It's down. This chart, for the most part, moves in this direction. Similar situation, value relative to the S&P 500. We're still down here, and we've been up here, and up here back in June of last year. Now, that energy breakout relative to the S&P 500 tells us have to be open to value breaking out as well. That may happen, but there's a lot of white space in here now. The longer-term look of value divided by growth. Another look, long-term value divided by growth. Intraday, February 10th, growth relative to TLT, recapturing the 200-day moving average. There's a weekly chart here. It's dated February 4th. If you pause your video player, these V-type looks have come near major lows in the S&P 500. Caveat is we don't know what this is going to look like at the end of the week because Friday is really going to determine that. But we do have somewhat of a similar early stage look here. Of course, that's to be determined. Like many of these charts, we'll learn something either way. If this look here morphs into something like this, that tends to speak to higher odds of more downside. This will give us a good look at tech relative to energy. This is during the session on Thursday, February 10th. Here's this huge gap here. Look at this white space in here. Come back to it before. Battling in that general area now. Another inflection point look here. Inflection point doesn't say we think it's going to hold or not hold. It's saying you could get a rapid move in this direction or a rapid move in this direction. XLK in isolation during the session. A double top look in the short run, that would be the bad news. Resistance from here, that would be the bad news. The good news is very short stay below an upward sloping 200-day. Not a particularly alarming look yet, but if price were to close in this area here and make a lower low here, then that starts to change relatively quickly. And maybe more importantly, if we close below this level and this level, the longer we stay there, the more this looks like a rollover look. Right now, what this looks like is there really wasn't a lot of selling pressure near the 200-day here. Here's the COVID plunge over here, equal weight S&P 500, which is still duking it out relative to the S&P 500. And our SP probably has the upper hand in the short run. SPY has the upper hand in the long run, so both of them still look pretty good. Kind of a max fear look below the 200-day. On Thursday, February 10th, this printed a new all-time high, and that was the day the stock market plunged. Very, very difficult to say that this is a concerning look in its present form relative to this over here. Now, that can change very, very quickly if this ratio gets down here. You can pause your video player, but remember, markets are forward-looking mechanisms. It's possible sometime in the coming weeks and months that the market will start to look ahead relative to inflation expectations and interest rates. That hasn't happened in a meaningful way yet. Pause your video player here, but this is basically saying, trying to compare the present day to the financial crisis from some fundamental perspectives is very, very difficult. Also, some hard data that tells us inflation expectations may have already peaked. Once the Fed starts raising interest rates, gets into a new cycle, does that mean stocks are necessarily dead in the water? History says absolutely positively no. The average number of years that the market rallied, about 3.3 or 3.4. The average gain after the first rate hike, about 67%. The first rate hike is coming in March, for the most part, unless there's an emergency meeting, and that's highly unlikely, but not totally out of the question. Pause your video player. This is performance before the rate hike and after the rate hike. After the rate hike, average gains 6 months later in tech, a possibly surprising 11.2%. Financials 3 months after the first rate hike, down 6% on average. 6 months later, basically flat. Really can't make the assumption that tech is necessarily dead in the water, the top performing sector during these cycles here where the Fed was raising the federal funds rate. Not a prediction in the present day. It's just saying historically don't make any assumptions about what's going to happen to tech based on rate hikes. Lots of pay attention to charts, commodities, physical commodities relative to the S&P 500 long term. Here's the end of last month. Here's intra-month. Large cap stocks relative to energy intra-month. Here's the end of last month. A lot of inflection point looks here as well. Very, very difficult to say that this is a good-looking chart, and this says we should be open to tech such as XLK still breaking down. This is ARKK relative to SPY. This is the 50-month moving average. This is February 7th. You want to keep an open mind about worse than expected outcomes in the short run. You could say that this ratio has a failed breakout here, and if we came down in this direction here, that typically would be associated with the stock market falling further. This was a little surprising too. This ratio for the month as of February 7th was down 0.67%. February 10th at the close, it was up 0.46%. Nothing earth-shattering, but that's surprising given price action in the S&P 500 on Thursday. A lot of inflection point looks. XLF is strong in here on your shorter term time frames, but this is the look of the chart at the end of January up here, monthly chart. Welcome back to the future, Friday evening, February 11th. There was significant and relatively rare in terms of the speed of the deterioration in the data after Bullard's remarks on Thursday. That carried into Friday's session. Mathematically, we looked quite a bit different midday on Thursday up near the session highs relative to the close on Friday. Nothing really new here. We have to respect risk until we see observable improvement. The weight of the evidence needs to shift. It's shifted in some ways, but we've never been able to get over that bull-bear tipping point. We got right up to it on Thursday, and we failed. That's not highly unusual or particularly surprising. One good thing that may come out of this, we've had all types of confusion relative to market leadership. So on the other side of this, it's quite possible some new and stronger and more discerning trends will emerge, especially on a relative basis. It's very, very easy when the market's falling to believe that it's going to fall every single day for the rest of your life. It just doesn't work that way. The weakness, for the most part, sets the stage for the next advance. And this bullet point here is in the context of this bullet point here. Typically, when you have a correction or a pullback similar to the one we're experiencing now, typically they end with some type of very discernible, measurable, and observable thrust in the breadth data. Came close to having some of the breadth data flip over, but when it got up to that bull-bear tipping point this week, it failed. So this is something that we'll be looking for in the days and weeks ahead. There's a common sense market axiom that says the market will continue to fall or be volatile or be bothered until the issue that it's concerned about is cleared up in some way. So for example, we had an inflation report on Thursday. If that came in better than expected or less bad, that could have done it. But that's not what happened. It came in worse than expected. So rather than clearing up the concern, it really threw a little bit more gasoline on the fire. All of the bullet points that we covered earlier in the video still apply, but the big ones are no assumptions about anything that happens in the short to intermediate term. Continue to trade the chart in front of us, and that includes the hard data in front of us. It's always important to be thinking about multiple time frames. When the market's falling, it's very, very easy just to get focused on the red screens in front of us. But just like the market reversed after Bullard's remarks on Thursday, something very, very similar can happen near a bottom. The market can look very, very bad. You can be at maximum fear, and then very, very quickly something can change, and you can move into a thrust or a sharp reversal. It's very, very important in terms of redeploying capital to be incredibly nimble. Really, the only way that we can be nimble is if we're emotionally prepared for sharp reversals. And until the market shows us something, we really head into Monday's session with a very, very similar game plan. The same type of approach that we had up here on Thursday night now applies to this base here. We take it day by day. We don't make any assumption that this low here is going to hold or that this low is going to give way. And we all know the only way that any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.